Hi, I'm Ian Stewart, Chairman of the Board of Leithner Company. Today's presentation by Chris Leithner and David Guy, our joint managing directors, and facilitated by fellow director Chris Satsopoulos, is about our performance in the first 6 months of the current financial year, 2022-23. I'm sure that after watching this video, you'll agree that Leithner Company has had a strong performance during this period. Should you wish to find out more about Leithner Company, there is details provided at the end of this video. So sit back and enjoy Leithner Company's performance video for the last 6 months.
Thanks, Ian. Welcome, everyone. I'll move to the disclaimer first, and if you're watching this, please pause it and review the disclaimer carefully. Today, we'll cover 4 main areas. We'll look at the long-term investment performance of Leithner Company. We'll go through the sources of income and dividends, get some further information about the additions to the portfolio that were made in 2022, and then to finish up, discuss how you can invest and contact the co-managing directors to find out more about Leithner Company. Now let's turn to the slide about performance. Performance since inception has been very good, keeping pace with the All Ordinaries. And as we know, it's very hard. Most managers, about 80% of managers, actually don't keep up with that All Ords accumulation index. Chris, tell us more about that journey.
Okay, thank you, Chris. The key point is that the CAGR, the compound annualized growth rate, since 1999 is 7.7%. That's up to the 31st of December of last year. Each dollar invested with us back in 1999 now has a market value of just short of $5.50. The actual number is $5.43. The graph slopes nicely upwards. And whether it's during the GFC or during the COVID-19 crisis back in the first quarter of 2020, we've outperformed when the All Ords has swooned. The extent, the length of our outperformance during and after the GFC is particularly worth noting. And the sum of it is that we like bear markets because they allow us to put cash to use, and putting our cash to use sets the stage for long-term outperformance.
There's 4 sources of income that Leithner & Co. generates. Perhaps you can go through those.
Okay, we're on the next slide now. We generate income from, first, payments of interest from our portfolio of bonds, deposits, and so on. Secondly, we receive dividends from our portfolio of shares. Thirdly, we receive premiums from the derivatives, particularly the options that we write. And fourthly, we receive realized capital gains when we dispose of securities profitably. 2 of those 4, namely dividends and interest, are very stable in the sense that each half year since 1999, we've received interest, we've received payments of dividends. The other 2 payments, premiums from options and realized capital gains, are less reliable, but sometimes they're quite lucrative. More than that, the premiums from options and the realized capital gains are negatively correlated. In plain English, the less is the one, the more is the other. So the less capital gains we receive, the more options income we tend to receive, and vice versa. And the crux of that, the upshot, is that we benefit both from falling as well as rising markets. So looking at the chart now in a bit of detail, over the past 5 years, namely since 2017, dividends have provided the biggest share, roughly 1/2, slightly less than 1/2 of income. The premiums from options and realized capital gains have each provided about 20% of the half-yearly income, and payments of interest, the remaining 10% or so.
What have the dividends been like since the last 5 years?
Okay, well, let me start with the most recent dividend. We're paying it shortly on the 15th of February. It'll be approximately 2.2 cents per share. On an annualized basis over the past couple of years, it's been approximately 4 cents a share. That's less than the average over the past 10 years, which is 6.5, 6.6 or so. This returns to a previous point. Our lower recent payouts have mostly to do with the fact that we've not harvested any capital gains since 2020, 2021. When we do, as you can see in the graph, our payout can lift considerably. So I guess the point about dividends is that there's a sort of a base level, which derives primarily from payments, dividends that we receive and payments of interest. And then occasionally when we receive realized capital gains, there's an oomph or an increased payment of dividends.
Thanks, Chris. Now, turning to the results over the last 12 months, how did we go, David?
Thanks, Chris. We did well. It was a difficult environment, and I think most people appreciate that. We had a generational type increase in interest rates, which resulted in a lot of people losing money. Our pre-tax returns are 6.9% for the full year to December. That compares with the All Ords, which lost 2.5%, the Future Fund, which lost 3.7%, and the Medium Balance Fund, which actually lost 4.8%. So compared to those, we've done very well. It's significant outperformance. A lot of that comes from what Chris has already mentioned. We have a stable base of recurring income that comes through the company from our interest, from our dividends, but also from those more variable sources. In that period of time, we did quite well from getting premiums from options, for instance. But over and above that, we've done quite well on the underlying investments that we make, the shares that we purchase on market. So at the start of the 2022 calendar year, we owned 12 stocks. Those that we held for the end, out of those 12, we had 7 that went up and 5 that went down. So in a pretty difficult environment, we managed to do pretty well in that case. We think that's to do with the deep level of research that we do. The investments that we make should have less downside risk than the average share out there. And it's pleasing that that's shown up through that period.
Okay, well, that's, I guess, in the past, and they're great results for existing shareholders. But I guess both current and potential shareholders are more interested in the future. So what can you say about that?
Thanks, Chris. Yeah, look, the future's always difficult to predict in detail. What we can say is we do the same thing every day of every year and have done since we started. We're value investors. It's worked for 20 years. We expect it will continue to work for another 20 years. Before us, it worked for Ben Graham going back 100 years. So value investing is something that's tried and true. In terms of us and our earnings and dividends, particularly to our shareholders, we think we've got some tailwinds. So we've got 3 main tailwinds. The shares that we've previously owned or that we currently own are dividend stable to rising. We think on balance, in aggregate, that those companies will increase their dividends over time. Secondly, as I mentioned, there's been a massive increase in interest rates at market levels from, RBA cash rate of 0.1 to 3.35%. So it's a pretty significant increase. We have roughly 50% of our assets in cash or equivalents. So that flows through to our earnings directly. And thirdly, for the last 12 months, we purchased 4 new investments, all of which pay income. And they're all varying companies. We've purchased shares in Charter Hall, Long Whale REIT, Goodman Group, IAG, and Insignia Financial. So if you have just a look at, for instance, Charter Hall there, we're looking at a distribution yield of 7.2%. The aggregate of those 4 stocks is a dividend distribution yield of about 5.3%. So again, that's another tailwind. We can't control the capital gains. We can't control the market for options, but the underlying earnings are pretty solid from our perspective going forward. We think they're stable to rising. So that's a good place for our shareholders to be.
That's great, David. Sounds like the portfolio is well positioned. What else do you think you need?
Look, Chris, from our perspective, we think we provide an investment for people that's very conservatively managed and provides a very consistent income. And we think there are shareholders out there who would find that attractive. Where we think we can handle a lot more shareholders than we have, and we're looking forward to talking to people about that. We've got a lot of research that will give comfort to people about the depth of research that we go into before we make investments. So if anyone wanted to contact us, we're more than happy to outline what we do, show you exactly how we've done it over a long period of time and why we think we'll be able to keep doing it over the next 20 years.
Thanks, David. So to sum up, consistent results in 2022, keeping up the long-term trend, and the portfolio is well positioned in the future for generating increased income. For those who are interested to find out more, please contact either Chris or David by email or by contact phone number to either get some more information about the investments or find more about the way Leithner & Co invests money. Thank you.